Welcome to another video that we explain what exactly volume is, difference between volume and liquidity, and how volume is acting as the most important indicator of all. So what exactly is the term volume? Volume in trading refers to the total quantity or the number of shares that are traded during a given period of time. It is measured across all types of financial commodities, including stocks, bonds, option contracts, futures contracts, and so on. Things that can affect volume could be news, economical releases, geopolitical events, and earnings. For example, on the side of earnings, if you are trading NQ and you have Apple, for example, and you get Apple earnings, you will see a spike immediately in volume. Okay, so higher volume implies higher liquidity since the securities are being exchanged more frequently. So how can we implement volume in our trading? Volume is a powerful confirming indicator of a trend. For example, when you have an uptrend, you have your trend line right here, and you have increase in volume, the odds that the uptrend will continue are high. Okay, so you have higher volume, it means that higher prices are attracting more buyers as well, and the price is moving higher. On the other hand, if you have the volume decreasing and making lower lows as higher prices is moving upwards, it means that there's a loss of momentum and a reversal is imminent. When it comes to a volume profile, let's take an example here. You have the point of control where the most volume was transacted, and you have low volume nodes at the edges of the distribution. This means that, for example, this could be in terms of price action, you will have a lot of activity and a lot of positions building here. Then the market moves higher. Low volume was traded here. It means that buyers and sellers did not agree at these prices, and the market moves towards the high volume node back in to the fairest price. Okay? What that tells us when you're looking at a volume profile like that, when the market is in balance, this will be key resistance for the market, while this is support. We will look at this example later on, but right here you have your resistance when this market could be on a range bound activity, and this is a support. Okay, unless you have increasing volume to break out from this support, supported, for example, as the market moves towards this area, you have increase in volume activity. Okay, when you have decreased in volume activity, you are expecting a bounce. Okay, towards the first price. Now let's talk about liquidity. In financial markets, liquidity refers to how quickly an investment can be sold without negatively impacting its price. The term liquidity refers to the level of swiftness with which an asset or security can be either bought or sold in the market for its market price. For big institutional investors, they need a long time horizon to buy or sell positions. Otherwise, they will start to impact the price of those securities. Now let's further understand liquidity using the order books. This is from ES. This is an order book from the Globex session known as overnight. And this is the US Open. So as we know, right here we have passive sellers and these are passive buyers. These are the bids and this is the ask, okay? Right here, ask known as offer as well. So for example, if someone wants to market buy, they will leave the offer. This is at the Globex session again, and we have lack of liquidity. Very often, when it comes to economical releases, you will see very few numbers here. It might be even at 5, okay? So if you were to buy here, let's say 500 contracts, and you had per tick right here, for example, this is 53.50, and you had 5 contracts, and you want to execute a 500 contract order, you will cross the spread, okay? So you will consume this whole order book, for example. That means when your intention was to buy at 53, you will end up buying this 58 as well, okay? So when large institutional investors take participation in the market, they more often than not, they don't want to trade on lack of liquidity markets. Okay, so they don't want to trade in Globex more often than not. Okay, so when they have to place a position of high magnitude or even 1,000 contracts, they will refer to the high liquidity US Open or the US Close, where per tick you also have like 200 contracts, as you can see here. And if they want to place an order, they will not negatively affect the price as much. Okay, so you have right here, you see the numbers change in comparison right here. It's a big difference. And again, when it comes to economical releases, very often you will see the market spike higher, within a millisecond of the release. This means that the lack of liquidity right here gives any type of trader the ability to move the price on their direction. Because if you execute a 100 contract right here and you have per tick, you have like 5, you have 9, you have 10, if 100 contracts will consume these whole orders right here. Okay, so this market is said to lack liquidity as people are removing their orders in order to reduce their exposure, and the market will move higher. Very much, like running through the forest. The more bushes you have in front of you, the harder it is to run. In this case, in a high liquidity market such as the US Open. So that's a very key difference between Globex and trading at the Globex, where you have smaller time frame traders and higher institutional traders will look at the US Open in order to execute their orders because they will not simply consume everything from this order book. Now let's put together everything that we learned about volume and liquidity in this realistic example that happened on Friday right here. And we have here the candlesticks, and this is the 5-minute, and we have the market profiles. This right here is a multi-day balance range. We just have the composite of this whole profile, and this is the Friday session. Right here, we can see the balance high and the balance low of this whole range. As we said earlier, this is key resistance for the market, and this is key support for the market. As you can see here, we don't include this Friday session on this composite, okay? So what we want to see when it comes down to break above a balance, this can be also true when it comes to a trend line. When you want your trend line to break, for example, the market is using this trend line to the upside, what you want to see is increasing volume, okay, in order to break. If you have decreasing volume as you enter or try to bounce off of this area, okay, on the trend line, you are likely going to get a nice bounce off of it. This is the scenario that happened in this case right here, both on the highs as well as the low. So you have, this is known as look above and fail, which happened right here. You can see here the market is coming off news. We had news. So you can see here the overnight how low volume in comparison to the open. Okay, so despite the key economical releases, the volume is much lower. And you can see here the market opens. Okay, this is seen on the profile as well. Moves lower towards this level right here, and then spikes above. What we see here is as the market moves higher, the volume is making lower lows. Okay, so this is key. When it comes down to breakout from this key area, we know this is a very major range. The market has spent a lot of time in its range. So what you want to see is as the market moves higher, you want to see market building, volume above this. This means that, it attracts the higher prices, attract more buyers. This wasn't the case. As you can see here, the market is making lower lows as the market moves higher. And what you get is a reversal. Okay, so again, this is the same when it comes to a pattern. Okay, so you have your pattern, you want to see a breakout assisted by higher volume. If you don't get higher volume, they always are good that there is a reversal underway. So what the market did after it looked above and failed, buyers failed to find any meaningful continuation, which means after you fail to break out of a balance area, look towards the opposite side of this balance and look what happened. the market moved lower, okay? So it bounced exactly at this key support area, because we said earlier, when you have your balance range, this is key resistance for the market and this is key support. And guess where the market ended, okay? So just 2 ticks below the low balance low, okay? So this was key support. As you can see here, this is, in this M period, you can see here how low volume was transacted as well here. Lower prices did not attract more sellers. This means that another reversal was underway. If you want to see continuation, you want to see this spiking as the market moves lower. But instead, we get a perfect bounce off of the balance lows, and the market, look where it finished. It bounced off and returned back to first price. As you can see here, this is where the cluster of this is an attractor of price, as we said earlier. High volume nodes are magnet of price. This is where buyers and sellers agree in order to transact, okay? And low volume nodes act as resistance and support for the market, seen as here, okay? So if you want access to this exact Sierra suite that we are using every single day in order to perform market analysis using order flow and market profiling, be sure to check our website. We have advanced footprints, advanced market profiling, and of course a 70-page ebook course that we can take that explains an introduction of market profiles, order flow, and market auction. We also have a set of bonus items for one price fee. Thanks for watching.